One of the central parts of the Republican tax plan in Congress right now is a reduction of the corporate tax rate for pass-through businesses. It's a move that they say will boost small businesses, create jobs, and in turn create growth. Well, one state actually tried this a few years ago, and the result? An economic and political disaster. This is what happened in Kansas. First, let's just talk about what is a pass-through business. Basically, it means that business owners can pay themselves without having to pay a corporate income tax. Instead, whatever amount the owners get paid passes through the business untaxed, and the owners declare it as income on their personal taxes. The entire setup has become pretty in vogue over the last few decades. According to the Tax Foundation, since 1980, the number of pass-through companies has nearly tripled, and they employ now more than 50% of the private sector. In Kansas, Governor Brownback wanted to restructure the state's economy as a shining example of what conservative economic principles can do. The centerpiece of the Kansas plan was a slash of the pass-through rate to zero. Zero. Brownback said that his plan would lead to an explosion in growth and job creation. Sure, there would be some predicted lost revenue, but that would be made up for by economic growth.
I want to use in our state the growth to ride the income tax rate down to zero, so you create a real growth atmosphere in our state, and that's the plan we've put forward.
Before, pass-through businesses would end up paying a tax rate of something like 6%. Under the new plan, that number would be nothing.
Like shooting adrenaline into the heart of growing the economy by taking that tax off a small business where most of your job creation is.
So what happened? Right away, the budget cratered. After the first year, the state's revenue dropped almost $700 million.
The estimate was 191,000 businesses would be able to take advantage of this. It was closer to 365,000. To lose 365,000 taxpayers, that's a big deal.
But all that money being injected into the economy would lead to economic growth and fill in the gap, right? Well, no, not really. Independent analysis showed that the plan that cost taxpayers hundreds of millions of dollars ended up not growing the economy at all.
So there was no increase in employment among these pass-through businesses, no increases in investment, and no significant increases in income earned by these pass-through businesses.
Instead of incentivizing job growth, the plan just gave people with pass-through businesses more money with the hope that they would hire people. But it did lead to growth in one area: the number of pass-through businesses. That's because high-earning Kansas residents figured out that if they just declared themselves private contractors and had their employees pay them through their company, they could avoid paying any state tax. That was just shifting money around. That doesn't lead to economic growth or jobs. It just leads to lower taxes for some rich people with clever accountants. Take Bill Self, famed coach of the Kansas University Jayhawks and one of the state's highest paid employees. His 2012 contract was signed shortly after Brownback's bill, and he got paid around $230,000 in salary and $2.75 million in, quote, professional services rendered, paid out to an LLC owned by him. And thanks to Brownback's bill, that $2.75 million passed through the LLC and paid no state income tax. So when a firefighter in Kansas City still would have to pay the state income tax, a millionaire head coach at a public university would not. The plan was such a disaster that in 2017, Republican lawmakers revolted against their own governor. With a massive budget shortfall and cuts being made to schools and roads with anemic growth, they ended up overruling Governor Brownback's veto and passing a law that rolled back the experiment. Now, back in Congress, the Republican tax plans are different than the Kansas ones. They're more complicated. They have some measures designed to prevent professionals from passing off their salary as business income. But experts are still warning creating a lower pass-through rate might only lead to job growth for CPAs and accountants.